Hello and welcome to Money Managers, a User's Guide. I'm Nathan Peters. Well, 2020 is about to become hindsight, thank goodness. To celebrate, I thought I'd do our take on a league table review of active managers over the year. First, we're going to ignore all actively managed long-only funds, as most of their volatility is driven by market risk. Second, we're not going to take returns as the be-all and end-all of achievement during the year. That wouldn't be true to our foundational concepts, which is one, risk is much more persistent than return, and two, demonstrated skill, while less persistent than risk, is more persistent than return. So we'll line up the top 20 liquid hedge funds of 2020 using data from our friends at Kepler, link in the description below, and then we'll decompose those returns by the risks they took to get that return using Venn, link in the description below, and then we'll use Venn's forecasting capabilities to project what that profile of risk-taking is likely to manifest in the future in terms of risk-adjusted returns, making some basic assumptions about forward-looking returns to equity, credit, bonds, and cash. I'm going to show you here. These are very simple capital markets assumptions. These are nominal returns, gross of cash returns, so it's MSCI index, we think it will make 3.9% over the next 3 years per annum. Global high yield bonds, maybe 1.9% per annum. Bonds, government bonds, about 20 basis points per annum, quite rich right now. And then local cash making about 2% nominal. If you want more details on how this is done, I've included a FAQ in the description below. Great, let's get into it. First, we see the titles that the top 20 funds of 2020 were largely focused on China and tech, and sometimes both. That's the list there. And when we take those returns, Venn spits out historical performance, forecast performance, we'll get to that later, risk statistics, factor exposures, factor contributions to risk, factor contributions to return, and then a nice correlation matrix as well. Now I've taken this block of data and just pulled together some scatter charts to try to tease out some relationships and conclusions. First, the more equity risk you took, the better you did generally with the positive relationship clear on the upper left-hand chart, with about over a third of the return explained by the market. Another way to look at this is to say, well, how much of the total fund risk is unassigned to market or factor risk, and how much alpha or skill risk is the manager taking? The results are on the top right here, and we see that the more alpha taken, risk taken, in terms of composition of risk, the less well you did in 2020. See the negative slope here. Okay. So equities were TINA in 2020, we get it. Well, how about the returns themselves, not the risk? Is there any relationship between how much alpha they generated and the return they generated? Here? Nope, pretty flat in comparison. Okay, now for the moment of the truth. Let's peer into our cloudy ball and see if taking all this risk data and assigning it to a reasonable forecast return will give us forecasted risk-adjusted returns in the future. Remember, risk and alpha are more reliable indicators of the future than returns are, and that's how we came up with the expected risk-adjusted returns in the first place. But sadly, our hunch was confirmed here. The fact that a fund was a top 20 performer in 2020 has nothing to do with how well it can be expected to do in the future. I have observed that the cult of copy-paste is running rampant among social media savvy fintech influencers, with automated investment strategies scouring professional funds for investment ideas, ETFs tracking the top holdings of famous fund managers, and hopping into the best performing actively managed funds. And speaking to my own experience, there are very few cases where that has been a profitable investing strategy. It's great for the managers, but horrible for dollar-weighted industry returns, as most of the eye-popping returns were underfunded versus very well-funded, lackluster subsequent returns. And there's a well-known hedge fund league table that is notorious for giving the top-performing fund in 1 year the kiss of death, where they bring up the rear in the following year. Hopefully, our little exercise today will stick in the back of your mind as you make fund allocation decisions in 2021 and make you question what sort of risks a fund manager took to achieve the returns you see and whether you think those risks will continue to generate those returns. Finally, a quick word of thanks to you for making 2020 a little more bearable for me personally. It's been a fun diversion, and I appreciate all the early subscribers' support. I'll be taking some time off for the rest of the Fridays this year, but not to worry, we'll be back in 2021 with tons more content. Shout if you have any burning questions when it comes to your money managers, and I encourage you to like, comment, and subscribe if you haven't done so already. And remember, use your money managers. Don't let them use you. Thanks. Take us away, Arnie.
Hasta la vista,
2020.
baby.